Welcome to the deep dive. Okay, so today, let's maybe set aside the usual market talk, the predictions, all that stuff.
Yeah, let's get into something maybe more fundamental.
Exactly. We're diving into why we actually do the things we do with our money. And that really means talking about psychology.
It's fascinating territory. Our main guide here is Morgan Housel's The Psychology of Money.
And one of the big ideas, maybe the biggest, is this: being good with money. It often has, well, less to do with how smart you are.
And much more to do with how you behave, your actions.
Totally. We get caught up in the mechanics, right?
Look.
Strategies, rules.
All the technical stuff. But Housel really shines a light on how our, human nature, our emotions, that's what's really driving the bus financially.
He uses this amazing contrast to make the point. Think about this.
Yeah.
You've got this super successful executive, tons of money, clearly smart.
Right.
But he impulsively spends, thousands of dollars on a broken lamp in a hotel because he's mad.
Just snaps. Loses control.
Yeah, and that lack of behavioral control, well, it played a part in him eventually going broke, despite all the resources.
It's incredible.
Then you flip it. You look at Ronald Reed, janitor, gas station attendant, no fancy finance degree.
Not at all. Just a regular guy.
But through just steady, patient saving and investing, year after year, he ends up a multimillionaire.
A philanthropist.
It's such a powerful comparison. Really shows that knowing the formulas isn't the whole picture, not even close sometimes.
So that's our mission for this deep dive, really. We want to unpack some of these core psychological ideas about money using the material you've brought.
Trying to get under the hood of our own financial thinking.
Yeah, like how our personal histories shape everything. And maybe, just maybe, start to understand why we make the choices we do and why other people's choices sometimes seem baffling.
Oh, yeah, baffling is a good word for it sometimes.
It's like shifting the view from money as physics, fixed rules, predictable outcomes,
to money as psychology, full of emotions, nuances, individual stories.
And once you make that shift, a lot of things start to click. Behavior that seemed totally illogical suddenly makes a kind of sense.
Okay, so let's peel back that first layer. This idea of personal history being just incredibly powerful.
Hugely powerful. Housel's point is that we all have our own unique lens on how the world works, right? And what we experience ourselves.
It's way harder than anything we just read about or hear secondhand.
Absolutely. Think about inflation. If you lived through a time when prices were just soaring.
Your gut feeling about saving versus spending, about what investments feel safe, it's just baked in.
Completely different from someone who only ever knew stable prices. Those early experiences create these really strong mental frameworks. They stick.
The material gives some great examples, like growing up poor versus wealthy. That changes your whole calculation around risk.
Totally.
Or imagine living through the Great Depression. That wasn't just an economic event. It scarred people psychologically for life,
Yeah, deeply. Their view of banks, of the market.
Completely different from someone who came of age during the 90s tech boom. Just a world apart in terms of financial optimism.
And it's not just about different eras. Look at Australia, 30 years without a recession.
Incredible, right? Think about the baseline financial psychology that creates compared to the US with its regular cycles.
It's like financial DNA. Your early environment just writes itself onto your outlook. Poverty can make you super cautious, maybe too cautious. Wealth can sometimes breed a sense of entitlement or blindness to risk.
And the crazy thing Housel points out is that our personal experience, which is like this tiny sliver of global financial history.
Like 0.000000001%, he says. Almost nothing.
It can still account for maybe 80% of how we personally think the financial world works.
Which explains so much disagreement. You get brilliant people arguing opposite sides on recessions, on investing.
It's not because one is smarter. It's because their personal history is this massive anchor they might not even realize they're dragging.
Exactly, and there's research to back this up. A study showed investor risk tolerance. It lines up way more with their personal history than their IQ or education.
That's wild. It's not about the spreadsheets, it's about your life story.
It really is. And it's not just small investors. Think about Bill Gross, the bond king.
Right.
He himself said, look, a huge part of my success was just riding this massive generational wave of falling interest rates.
The timing was perfect for his strategy.
For him, bonds were amazing wealth creators, but his dad's generation,
Yeah.
who saw inflation eat away savings, they might see bonds as, wealth incinerators.
Same asset, totally different perspective based purely on when you lived.
It's a perfect illustration, and the material shows these huge gaps, even within the same country at the same time.
Yeah, like the unemployment stats.
Yeah.
The rate for, say, a young African-American guy without a high school diploma versus an older white woman with a college degree.
Worlds apart. Their day-to-day economic reality is just fundamentally different, creates different financial outlooks, different priorities.
And zoom out globally. The impact of something like World War II on Germany or Japan's economy versus the U.S. post-war boom
Creates foundational economic experiences that are just radically different. You can't expect people from those backgrounds to view economic stability or markets in the same way.
And that anecdote about the factory worker in a developing country?
Yeah, their idea of acceptable conditions is shaped by a reality that's, well, hard for many in richer countries to even imagine.
It really challenges any easy black and white judgments about financial stuff, doesn't it? Our lived reality shapes our financial truth.
And what's really interesting is how these personal histories then lead us to create these individual narratives, stories we tell ourselves.
To make sense of it all.
Exactly. And Housel's point is crucial. Every single financial decision someone makes, it makes perfect sense to them in that moment. It fits their unique mental model, their story.
That's such a key takeaway, like the lottery ticket example. To someone financially comfortable, spending money on lottery tickets, especially if you're low income, might look totally irrational, crazy even.
From the outside, yes.
But if you step into their shoes, maybe that ticket feels like the only shot, the only glimmer of hope for a dramatically better life.
A dream that's worth a couple of bucks. It's a narrative of hope against long odds. Maybe the only hope they feel they have access to.
Which someone with more options might just not grasp emotionally. It requires empathy.
It really does. And speaking of narratives, the material also busts a common myth about retirement. This idea that, everyone used to have a solid private pension back in the day.
Yeah, the good old days.
Well, the numbers don't really back that up. Even as late as 1975, only about a quarter of retirees got any income from a private pension.
And often it wasn't that much, right? Not enough to live on solely.
Right. So this idea of retiring comfortably just on your own savings and investments, it's actually pretty new.
The 401k, the Roth IRA, they're relatively young inventions in the grand scheme of things.
Puts our current retirement anxieties in a different light, doesn't it?
It does. And that leads nicely into another area the book explores, luck and risk. Their roles are just massive, but often overlooked.
We love attributing success purely to skill and failure purely to bad choices. It's simpler that way.
But the reality is way messier. Robert Shiller, the Nobel Prize winner, basically asked, what can't we know about investing? Highlighting that huge zone of uncertainty.
And we have this bias, don't we? That attribution bias.
Oh yeah, someone else messes up, clearly their fault, bad decision, we mess up.
Oh, that was just bad luck. Unforeseeable circumstances.
Exactly. Makes it super hard to objectively figure out how much was our doing versus just random chance or risk playing out.
The book uses the example of a stock that just goes sideways, does nothing for years.
Was that a bad pick? Or was it a reasonable bet that just didn't pan out because of risks you couldn't control?
Often impossible to tell for sure, even in hindsight.
And history's full of examples. Cornelius Vanderbilt basically ignored the law to build his railroad empire. He succeeded, so now he's a visionary, right?
A titan of industry.
But if he'd failed, he'd be remembered as reckless, a lawbreaker. The outcome defines the narrative.
So true. Or Benjamin Graham and Geico. His biggest win came from a super concentrated bet that broke all his own diversification rules.
Was that genius insight or just incredible luck? He apparently wasn't even sure himself.
Which is why the book suggests maybe we shouldn't focus too much on these extreme outliers, the billionaires and the bankruptcy.
Yeah, maybe the lessons from the average experience are more useful for most of us.
Probably. As Bill Gates said, success is a lousy teacher. And sometimes failure is too, because it can obscure the real role risk played.
So what's the takeaway? It seems like it's about building a financial life that can survive the hits. Resilience.
Financial endurance, exactly. Staying in the game long enough for the odds to hopefully turn in your favor.
And that brings up John Bogle's story about Kurt Vonnegut and Joseph Heller.
Yes, at the billionaire's party. Great anecdote.
Heller points out that he has something the billionaire host will never have.
Enough. The knowledge of having enough.
It's so profound because the book makes this point. Social comparison, that ladder goes up forever.
Infinitely high, There's always someone richer.
So it's a game you literally cannot win unless you decide consciously, okay, this is enough for me.
That feels like a superpower in today's world. And the flip side is so dangerous. Look at Rajat Gupta.
Oh, man. Head of McKinsey, incredibly successful, wealthy beyond measure.
He had everything: reputation, respect, money.
But he needed to be a billionaire? That gnawing desire for more led him to insider trading, ruined everything.
It's a chilling cautionary tale. Never feeling like you have enough can be incredibly destructive.
Like the long-term capital management guys, Nobel laureates, geniuses.
The smartest guys in the room.
Risking what they had and absolutely needed for something they didn't need at all, even more money. And they lost it all.
During a boom time, no less. It highlights Buffett's wisdom. Never risk what's important for something unimportant.
You have to know what those truly important things are: reputation, freedom, family, happiness.
Things money can't buy back if you lose them chasing more money. And knowing when you have enough to safeguard those things, that's real wealth.
Okay, let's shift gears a bit. Talk about time and growth. The book uses this analogy of ice ages.
Yeah, driven by tiny changes in summer temperature, just enough to let a little snow stick around year after year.
And over millennia, that tiny change accumulates into massive ice sheets. Small inputs, huge outcomes over long timelines.
It's a perfect metaphor for compounding in finance. Warren Buffett's wealth is the classic example.
Right, most of his fortune was made after age 50, and even more after 65.
The vast majority. His genius is undeniable, but his longevity as a genius investor, the sheer time his money has had to compound, that's the magic ingredient.
It shows how our brains aren't wired for exponential thinking. We get linear addition, but compounding. It just explodes in ways that are hard to grasp intuitively.
Which leads to this crucial distinction the book makes: getting wealthy versus staying wealthy.
They are not the same skill set.
Not at all. Think of Jesse Livermore, incredible trader, made fortunes and lost them multiple times.
Or Abraham Jermansky, wiped out in the '29 crash. They knew how to make money, but not how to keep it.
So the secret sauce for long-term success, it really comes down to survival, just staying in the game.
Michael Moritz from Sequoia Capital basically said their success comes from being constantly afraid of going bust, never getting complacent.
Because compounding needs years, decades even, to really work. And to give it that time, you have to survive all the market's craziness, the unpredictable downturns.
Which is where margin of safety comes in, that buffer.
Exactly. Room for error. It's not just about numbers on a spreadsheet. It's a frugal budget. It's flexible thinking. It's having a loose timeline so you're not forced to sell at the worst moment.
It increases your odds of sticking around. The book even uses this brain analogy, synaptic pruning.
Yeah, the idea that the brain gets stronger by eliminating weaker connections. Destruction as part of progress.
It makes sense. Loss and setbacks are kind of normal, even necessary for long-term growth in volatile systems like markets or economies.
Look at the U.S. economy over, 170 years? Tons of recessions, market crashes, wars, inflation, endless pessimism in the headlines.
Yeah.
The average standard of living increased something like 20-fold. Incredible progress despite constant turmoil.
So you need this weird mindset, right? Short-term paranoia to avoid getting wiped out.
But long-term optimism to stay invested and benefit from that overall upward trend.
It's also comforting, in a way, to know that being wrong is normal in this field. The book says being wrong maybe half the time in investing or business is common.
We just underestimate how often things fail, so we overreact when they do. Think about Walt Disney.
His first studio went bankrupt. Most of his early cartoons lost money.
But he survived those failures, and the successes eventually outweighed them massively.
Which ties into the idea of tail events, these rare outlier events that drive most of the results.
Yeah, like in venture capital, where a tiny fraction of investments generates almost all the returns. The stock market's actually pretty similar.
A small number of companies are responsible for the bulk of the market's overall gains over time. And even established public companies fail more often than we think.
Absolutely. Look at Amazon or Apple. Their huge success isn't built on hundreds of equally successful products.
It's driven by a few massive tail hits, Prime, AWS, the iPhone.
Right. So maybe success in investing isn't about always being brilliant. Maybe it's just about doing the average, sensible thing consistently, especially when everyone else is freaking out.
Peter Lynch said being right 6 times out of 10 in investing is terrific.
Which is way different from needing perfection in, say, surgery or engineering, and Jeff Bezos' attitude at Amazon.
Viewing big failures not as disasters, but as part of the process. necessary steps towards finding the next huge success, like AWS.
Exactly. It's that resilience again. And George Soros put it perfectly. It's not whether you're right or wrong that's most important.
But how much you make when you're right versus how much you lose when you're wrong. Managing the downside. Survival. Okay, shifting perspective again. Let's talk about what money actually buys, beyond the obvious stuff.
The intangible value. This is a big theme. Money can buy things like control over your time, options, freedom.
And those things can be way more valuable for happiness than just more material possessions.
Your own story about that investment banking internship really hits this home.
Yeah, the money was great, obviously, but having zero control over my time, being on call 24/7, it just wasn't worth it. I realized pretty quickly that autonomy was more important to me than the huge paycheck.
That control over your schedule is a massive component of well-being. And the book points out how modern work, these thought-based jobs,
Can feel like they never end because the tool, your brain, is always with you. The lines blur.
making that control over time even more precious and maybe harder to achieve.
There's also that paradox. People chase wealth hoping it'll make them admired, liked,
Look, they want the signal it sends.
but often people don't admire you, they just admire your stuff, your car, your house.
Right. The book argues that things like humility, kindness, empathy, those actually earn you more respect in the long run than a fancy watch.
Which connects to the difference between wealth and richness.
Yes. Wealth is what you don't see. The savings, the investments not yet spent. Richness is the visible stuff, the spending.
So building actual wealth often comes down to your savings rate, how much you don't spend, regardless of your income. That gap is what buys you independence.
The energy efficiency analogy is great here. It's often easier and more impactful to become more financially efficient, meaning frugal, high savings rate, than it is to just earn more income. You have more control over your spending.
And saving isn't just for a down payment or retirement. It's saving for the unexpected, saving for freedom, saving to have options.
Every bit you save is like buying back a piece of your future time, giving yourself more control down the road.
Now, this is a really interesting idea. Being reasonable versus strictly rational with money.
Yeah, this acknowledges the human element again. The story about the doctor who won a Nobel Prize for inducing fevers to treat syphilis.
Crazy, right? Fever was medicine in that case.
But does anyone not try to suppress a fever when they have one? Of course not, because fevers feel awful. It's reasonable to want to feel better, even if technically, maybe the fever is doing something useful.
It's a perfect analogy for finance. We don't always do what's mathematically optimal on paper because, well, we're human, we want to sleep at night.
Exactly. Harry Markowitz, another Nobel laureate, initially just split his own money 50-50 stocks and bonds, not because some complex model said so.
Because he figured it would minimize his future regret either way. That's reasonable, even if it's not perfectly rational in a purely quantitative sense.
Think about leverage. Using lots of borrowed money might look great in a spreadsheet if things go well.
But can you actually stomach the massive losses if things go wrong? Most people can't. It's rational on paper, but maybe unreasonable in practice for a human being.
Or investing in things you're interested in. Maybe not the absolute highest expected return, but if it helps you stay the course during downturns because you actually care about the companies.
That's reasonable.
Yeah.
Even home bias, favoring stocks from your own country. Maybe not purely rational diversification, but the familiarity provides emotional comfort that keeps people invested.
The book even floats the idea that maybe having a tiny play money account for day trading, if it scratches that itch and stops you from messing with your serious long-term investments, maybe that's reasonable too.
Containing the irrationality, so to speak.
And even making forecasts. We know most are wrong, but doing it feels reasonable, like we're trying to get a handle on things.
Even Jack Bogle, Mr. Low-Cost Index Fund himself, apparently invested in his son's higher fee funds.
A reasonable personal decision trumping strict financial dogma. It happens.
Okay, another big caution. The historians as prophets fallacy. Relying too much on the past to predict the future.
This is so important. History gives us context, absolutely. But it's not a perfect roadmap, especially when the world changes.
Things do change. New technologies, new regulations, new systems like the 401k or venture capital. These create structural shifts.
So just because something happened before doesn't mean it will happen again in the same way. It's different this time. Warning is usually right.
But sometimes it actually is different. Look at Benjamin Graham himself, constantly updating his formulas because the market changed. What worked in the 1930s wasn't optimal later.
He even moved away from complex stock analysis later in life, recognizing the landscape had shifted.
Just because you lived through past events doesn't make you a good predictor. It might even make you overconfident. Well, I've seen this movie before.
But the sequel might have a different ending. And major unexpected events, those tail events like 9/11, they changed the trajectory in ways no historical model could foresee.
Kahneman's point is key. The lesson from surprises isn't that we'll learn to avoid that specific surprise next time.
It's that the world itself is surprising. We should expect the unexpected. Always.
Now, let's tackle pessimism. Why does it often sound so much smarter?
It's a great question. Pessimism often gets more attention, more credibility than optimism, even though long-term, the world generally does get better.
Real optimism isn't wishful thinking, right? It's believing the odds are generally in favor of progress over the long haul, even with bumps along the way.
But pessimism, it feels cautious, intellectual, like you're seeing the risks others are ignoring.
Remember that 2008 news article predicting the US would break apart?
On the front page, extreme pessimism gets taken seriously in a way that extreme optimism rarely does.
Matt Ridley said the reasons for pessimism change, but the pessimism itself is constant.
And Hans Rosling showed people consistently think the world is way worse, more dangerous, more hopeless than the data actually shows.
Why is financial pessimism especially easy and persuasive?
Well, money affects everyone, so bad news travels fast and wide. And negative stuff like a crash happens quickly. It's dramatic, visible.
While progress
It is usually slow, incremental. Compounding happens quietly over years. It's less noticeable day to day.
Like the Wright brothers. The newspaper declared flight impossible right before they did it. And even then, it took years for people to really get the significance.
Compare that to a bankruptcy or a plane crash, immediate headlines. Growth compounds. Destruction is often instantaneous. Loss of confidence can happen overnight.
Think about progress like the huge decline in heart disease deaths over decades. Massive improvement.
But it doesn't grab headlines like a sudden market dip or a specific tragedy, even if the long-term impact of the progress is far greater.
And the narrative damage from something like 2008, the loss of trust, the fear, that had huge economic effects beyond just the numbers. Pessimism becomes self-fulfilling sometimes.
And when stakes are high and information is incomplete, like in finance, people are more likely to grasp onto compelling stories, even if they're negative or unfounded. Like historical bloodletting or, listening to some guru predicting doom today.
Or the Madoff scheme.
Yeah.
People wanted to believe that too good to be true story.
Which brings us right back to the power of stories and mental models. We're narrative creatures.
We build stories to make sense of things, starting from when we're tiny kids.
And even when we think we're being objective, say, looking at history, we're filtering it through our own biases, looking for evidence that confirms what we already believe.
Kahneman nailed those planning biases. Focusing on what we can do, ignoring competitors, overplaying skill, underplaying luck, focusing on knowns, ignoring unknowns.
All leading to overconfidence in our neat little stories about how things work.
The book uses that alien analogy, observing Earth, thinking you understand everything just from watching.
While being totally clueless about the inner lives, the histories, the complex motivations driving everyone's actions. We do that with each other financially all the time.
So let's try to distill some actionable lessons as we wrap up. The book is careful not to give specific, do this advice.
Because everyone's situation is unique. But there are definitely recurring themes, guiding principles.
Like finding your enough. That seems critical.
Absolutely. Less ego, more humility, higher savings, using money not just for stuff, but for control over your time.
Being nicer, less flashy, worshiping room for error, that margin of safety again.
Avoiding financial extremes. Recognizing that you'll change over time, the end of history illusion, so plan for flexibility.
Knowing when to cut your losses, avoiding sunk cost fallacy. Understanding that volatility is the price you pay for potential returns.
Recognizing social comparison's pull on your spending. Defining your own game and ignoring the noise. And always being aware of that siren song of pessimism.
You shared some personal reflections that really illustrate these points. Your parents living below their means.
Yeah, that gave them incredible freedom later in life. Financial independence.
And your own approach, keeping your lifestyle stable, even as income grew, deliberately maximizing savings.
It's about prioritizing that independence, that buffer.
Even choices that aren't strictly rational on paper, like owning your house outright or holding more cash than recommended.
For me, the feeling of security, the oxygen of independence, as I call the cash, knowing I won't be forced to sell stocks at a bad time, that psychological benefit outweighs the potentially lower returns. It's reasonable for me.
It really shows that sometimes being happy beats being technically right.
Exactly. Good financial decisions should lead to a better life, not just a better spreadsheet.
Okay, one last piece. The history of consumerism. Just a quick overview.
It provides useful context for our current attitudes. Post-WWII, there was a deliberate effort to boost consumption. Fear of another depression, plus pent-up demand.
And policies encouraged it, low interest rates, the GI Bill helping people buy homes, the rise of credit cards.
Plus, productivity boomed. Wages rose, especially for the working class. The income gap actually narrowed for a while.
There was this sense of shared middle-class possibility in the 50s, 60s, into the 70s.
But then, starting around the 80s, things shifted. Income inequality started rising significantly.
Yet the cultural expectation of what a middle-class life looked like kind of stayed the same, or even grew.
Right. So, as median wages stagnated for many, people increasingly used debt to bridge the gap between their reality and the perceived norm, keeping up appearances.
That historical disconnect, rising expectations colliding with stagnant or unequal economic reality for many, might explain some of the underlying financial stress and dissatisfaction we see today.
It suggests that lingering feeling of this isn't working isn't just individual. It has deep historical roots in these economic and cultural shifts.
It's a really powerful lens. So wrapping this all up, the big message really is understand the psychology, yours and others.
Yeah, realize that so much of what looks irrational is driven by understandable emotions, histories, stories. It's not just about numbers, it's about people.
So we really encourage you, the listener, to think about your own financial story. What experiences have shaped your beliefs about money?
Could someone with different experiences have an equally valid but totally different perspective? And think about your future self. Might their values change?
Asking those questions, gaining that self-awareness, that's maybe the most valuable financial skill of all. It can lead to a much more intentional and hopefully more fulfilling financial life.